Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you very much for joining me. The Australian dollar bears pounded their paws hard yesterday, which in turn gave a further greater cry to the bearish sentiment. Failing to stage any break above 71 cents has now seen the Australian dollar turn back to the downside and erase most of this week's gains and posted a fresh low or an intraday low of 70.40 before short-term demand returned. Earlier yesterday, the data from China showed that industrial output expanded at its slowest rate in 17 years. The industrial production release expanded by 5.3% on a yearly basis in January to fall short of the market forecast of 5.5%. Furthermore, reports of the US planning to postpone the Trump-Xi summit to the end of April gave some additional weight on the Australian dollar. China retail sales also came in near forecast at 8.2%, but the unemployment rate climbed from previous 4.9% to 5.3%. From a technical perspective, I still believe the market will fall towards the region of 71.40.50, and even to the fact is to fall above the 71 cent handle. It is assessed that also the 60-day moving average, which is seen at 71.20, should draw the bears back to the challenge if we do see a rise there. At present, though, I do expect to see the market turn back towards 70.40 and then beneath there, the base or this year's forecast of 69.40.60. While the euro backs away from the resistance of 113.55 overnight, as the greenback outperformed its rivals after spending most of this week under pressure, which in turn fueled the rise for the euro above 113 for this week. The US dollar index, which measures the greenback strength against a basket of 6 major currencies, plummeted to a 10-day low to 96.39 yesterday before finding its footing and recouped some of its losses by about 34 points. With demand returning to the US dollar, the bears retaliated in front of the crucial resistance level of 113.55. It is assessed from a technical point that we should not put all our faults to the bear case in case we do get a step back to the top side again. As you can see, the market hasn't broken down from a technical point, so we could see one more challenge towards 113.55. And do remember, if we see a break, could trigger stops up towards the region of 114. But this should give us opportunity to shorten the market. So I'd rather wait and see how it plays out in this, today's price action. Support seen at 112.85 and then beneath there 111.60.80. Well, the dollar yen has taken a step towards the upside and now pressures the level around 111.55.70. I've risen the resistance level a little bit because the fact of all these spikes and also the fact that technical implications aren't marrying up to support a bullish case. Therefore, with the lack of the follow through from the break of 55.70, I do expect to see resistance around 70.85, maybe to hold, and therefore look back towards 111.15 to 110.80 and reassess from there. Well, as you can see, overnight the market was very whipsawed for the pound as it swung between gains and losses after the votes at the UK Parliament eventually came in. MPs voted 413 to 202, a majority of 211 for the Prime Minister Theresa May to ask for the EU for a delay to Brexit. This means that the UK may not now leave on the 29th of March as previously planned. The UK Prime Minister is looking to see if she can delay the Brexit by 3 months to 30th of June if the PMs back her deal in a vote next week. If they reject her deal again, then she says she will seek a longer extension. But any delay has to be agreed by the 27 other EU member states. So from a technical point, we're not fully breaking down, but the resistance is still capping firmly from 133.50. And also for the fact is that we could see further weakness if we go beneath 131.80. This would give us at least 100 to 150 points swing back to the downside, but the base holds clearly from around 129.80. The gold plummeted overnight and as much as $18, taking out the level of 1,297. Keeping stops tight though, the market has now found support at 90. I would not at this stage get overly bullish at these levels, and we could still see a little bit more weakness. But we do need to see a good recovery soon, and if we fail to get that from 90, then we could be looking back towards the region of 80. But let's not put too many views on the bear case and see what turns from 90, because we can get a rise up to 98 to 05 or even up to 1012, which was the previous high. Wrapping up with oil, well, the market is still relatively bullish and holding above the $58 mark. As it closes in now on the 59 region, as we're trading quite close to it, after posting a high of 58.89 this morning, is that we could see a break towards $61 eventually. And with the measured move from this inverse head and shoulders, still gives us a target of between $63 and $64 a barrel. Support at this stage comes in around 57.10.15. Well, that wraps up for today. Thank you very much for joining me. And as always, look out for the intraday report. And I hope you enjoy the great start to the new weekend.